Google and Tesla both reported Q2 earnings. Both beat on revenue and both stocks got crushed. Google tanked nearly 7% after hours, while Tesla got punched in the face, falling nearly 15%. The reason? CapEx. Both companies are burning through a massive amount of capital building out AI infrastructure, and both companies are burning through free cash flow to do it today. So Wall Street's takeaway was simple. Rising CapEx, bad. Negative free cash flow, bad. Sell the stock. But I think Wall Street is being intellectually lazy. And here's the question I want to answer today. Was that reaction actually justified for both companies equally? Because when you look past the headline, these are two completely different stories wearing the same mask. But first, welcome back everyone to the Lunch Money Investing channel, where you get an ex-math econ nerd, that's me, to watch the market for you and break down 1 to 2 market moving events each week so you can make more informed decisions for your portfolio. And of course, protect that lunch money. If this type of content sounds interesting to you, please consider subscribing. It's free and lets my boss know, the algorithm, that this content is useful to other people. Anyways, let's get on with the main story. So let's start with the part everyone already agrees on. Google's revenue came in at $119.8 billion, up 24% year over year, marking their 12th straight quarter of consecutive double-digit growth. Tesla's revenue came in at $28.2 billion, up 26% year over year, beating expectations of $26.4 billion. This marks the first time that Tesla has ever crossed $100 billion in trailing 12-month revenue, a huge milestone for the company. Both beats, both capex increase, both stocks down. If you stopped reading right there, you'd think that these are the same story, but that's not the case. Let's dig into Google a little bit more first, because this is the clearest example of the market missing the plot. Google's cloud revenue grew 82% to $24.8 billion. For context, the street was expecting somewhere around 63%. That's not a beat, that's a total blowout. And it's not just growth for growth's sake. Operating margins actually expanded from 32% a year ago to 34%. Net income available to stockholders was up 298%. So here's a company whose revenue is growing at 24%, cloud revenue growing at 82%, and getting more profitable while doing it. So during the same period, capex jumped to $44.9 billion for the quarter, and full year guidance was increased to around $195 to $205 billion, an increase of around $10 billion. So as a result, free cash flow during the quarter went negative, down $5.9 billion. Now, normally negative free cash flow is a big red flag. Obviously, no one's in this business to lose money. But Google is sitting on $242 billion in cash and cash equivalents. This is not a company scrambling for capital. This is a company reinvesting because the returns are already showing up in the numbers today. Google isn't spending billions hoping AI works. They're spending billions because AI is already working for them today. Now Tesla, this is a different story here. And this is where the whole story changes overall. Yes, deliveries came in at 480,000 units, up 25% year over year. On the surface, that sounds phenomenal. But look at how they got there. Heavy price reductions and promotional financing to move inventory. And that showed up immediately in the margins. Automotive gross margins came in at 16.3%, well below targets of 19.4%. Operating margins overall collapsed to 1.4% compared to 4.1% a year ago. Earnings per share landed at 33 cents per share versus 53 cents per share, well below expectations. So clearly not quite the same story that we saw at Google. Anyways, on top of all that, capex jumped 142% to $5.8 billion for the quarter, driven by AI data centers and the Austin chip fab, and of course, Optimus production lines. Free cash flow as a result went negative $1.1 billion. So unlike Google, Tesla isn't spending big while getting more profitable. It's spending big while margins are getting substantially worse. That's a much tougher position to be raising capex from, and why I believe there's a real story here besides the headlines. And here's where I want to push back on my own story a little bit, because I think Tesla, it would be easy to dismiss the stock and say, hey, they had a bad quarter, so just avoid the stock outright. But I think it's a little bit more complicated than that, right? So going back to the auto deliveries, the price cuts to move that inventory were not just about clearing the lots. They're also about locking in something valuable, an install base. Tesla's FSD subscription, so full self-driving, grew 56% year over year. 55% of all North American deliveries now include an active subscription at $99 a month. So what I think is actually happening at Tesla is right now they are subsidizing the hardware, eating margins and accepting the loss today to get a bigger user install base for tomorrow. And right now, obviously the hardware is getting hit on the chin with gross margins at 16.3% and 1.4% operating margins overall. But if the attach rate for FSD holds above 55%, that discounted hardware can convert into an annual recurring revenue stream down the road. In my mind, Tesla is behaving like an enterprise SaaS company trapped inside a hardware manufacturer's body. My view is that this plays out slowly, slower than most people anticipate. I think the real earnings impact from FSD install base is the 1 to 2 year story. This is not a quick turnaround and why I'm not rushing to buy the stock today, but also why I wouldn't be betting against it, right? And there's room for Tesla, of course, to raise that $99 price to say $125 or something like that as the base matures, which would only accelerate this story and make the payoff come sooner rather than later. So in the near term, I expect Tesla to have another 1 to 2 rough quarters, and I think the stock moves lower before this thesis gets validated. But long term, there's a real asset here being built that the market isn't giving much credit for today. So what we just covered in my mind is first level analysis. Google reported decent results for the quarter minus the capex, and the stock fell. Okay, it's being undervalued by Google. Great. Tesla reported a similar story, but more nuanced, right? Their capex came as margins compressed. So similar story, but I think the takeaway is fundamentally different there. The second level analysis, the deeper level trade in my mind is both companies reported massive capex spend, which means both of them are pouring billions of dollars into AI infrastructure. And that money has to land somewhere. It doesn't just disappear. It becomes someone else's revenue. And right now, that someone are the companies selling the picks and shovels in this AI race. So names like Micron, SK Hynix, AMD, Intel, and NVIDIA. If you watched my last video on the memory stock players, I covered a bunch of these names and went over that space in more detail. And that thesis is playing out in real time from the demand side right now. In my previous video, I talked about it from the perspective of course, Micron, SK Hynix, and so on. But now we're hearing it from the people actually spending the money. The two biggest AI spenders on the planet just confirmed that they're accelerating the spend, not pulling it back. The Google versus Tesla debate might take a few quarters to resolve. The picks and shovels trades doesn't need that to actually happen today. As long as these two companies, well, not just these two, but as long as the hyperscalers continue investing in the space, the picks and shovels will continue getting sold and there will be winners in that space without having to pick whether Tesla or Google or Meta, what have you, is going to be the absolute winner, right? So what's the main takeaway and what am I doing? I think the main lesson here is identical headlines do not mean identical opportunities. On Google, I'm buying this pullback actively. A company growing at 82%, expanding margins, sitting on over $240 billion in cash, that's a dip, not a warning sign. The stock is around 320 right now. I'm comfortably adding more, and if it declines more, I'll be adding more aggressively, right? Now Tesla, that's a different story, a more nuanced story, right? So obviously they saw massive increase in the revenues, great for them, but that revenue growth came at a cost. On Tesla, I'm not buying yet. I think it's a more nuanced story. Not because I think the business is broken. The FSD numbers are genuinely impressive, right? When you look at that install base and the revenue segment from there, it's absolutely brilliant. At 313, I simply think there's a better entry point, and I think that number is closer to $240 a share. And I expect the next 1 to 2 quarters for the stock to get beaten down quite a bit because this story is going to take longer than many investors are thinking. Anyways, those are my thoughts regarding Google and Tesla and kind of what I'm doing in this space. As a reminder, I'm not a financial advisor. This is not financial advice. I'm just sharing my thoughts and my journey and what I'm doing, right? But I don't want the main takeaway to be buy Google, don't buy Tesla, or at least not yet. And not even the second level play, the Micron and the memory space and just the greater chip market trade overall. Those are all important details and obviously execution, how you might express a thesis in this space. Those are important without a doubt. But the more important message is this. Just because you see similar headlines and similar stock results does not mean that the underlying opportunity is the same, right? We saw Google and Tesla both fall because of the main concern being capex. They both share that concern from Wall Street's perspective, but the underlying opportunity between these stocks is not the same. And hopefully this video showed you that. Anyways, if you want to go into more detail regarding the memory chip space overall, be sure to check out my latest video regarding Micron, SK Hynix, and SanDisk. Very interesting, and it gives you another perspective on the AI supercycle. And as always, if you found this information valuable, educational, or just mildly informative, please like and subscribe. It means the world to me. I'll see you on the next one. And as always, protect that lunch money.